Welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next 25 minutes here on Options Guide TV. So the markets are a little strong today, and we did a bearish trade heading into Friday's close. On Friday's close, the market drifted northward and finished pretty much flat on Friday. And then today it's opened up a little bit. So our bearish trade in the SPX has not worked out. So I'm going to start this show by doing a quick adjustment. I guess the way that I would look at this is a learning experience in that if you are doing these type of trades, these are the type of adjustments that I would like to do. We're always doing the adjustments on the show with real markets. So sometimes the timing is off. I might have done it a little bit earlier this morning. Could have even done it on the close on Friday, but I wouldn't want to ride the whole weekend with the risk that the adjustment would bring on. So I'm going to show you two adjustments, and they're adjustments that I've shown before when we've talked about butterflies. And this is an okay adjustment. We got 1 day remaining to expiration. We put on a trade where we paid $2 for it, $2.10. Yeah, $2.10 is what we paid for the trade. And now the market has gone against us. We're up about 0.5%. Wasn't quite that bad this morning, but now it's up $24 in the SPX. Let's show the Tradier Pro. And the SPX is at 60.75. So show the software. There we go. And we see that the market right now here, the option grid inside the Tradier Pro software is highlighting where the market is at. These are the strikes of our trade. And here's the simple adjustment. Now, it's not a perfect adjustment in that it's not going to remove all of our risk. If we would have did it this morning, we might have had a little bit better chance. Maybe when the market was up 15 points or so, you would have had to be all over it right in the morning. But at this point in time, here's what the roll is. The position that we put on Friday was a broken wing butterfly, I guess. I'd like to say a modified butterfly is a better description. I don't like broken wing butterfly. I don't like that term. I've mentioned that more than once. It's implied that is a skip strike butterfly from my book, but this is where the market is at. This is the trade we put on. You have upside if the market tanks. Notice this is the 0 line. And we modified it. The long spread is 15 points, and the short spread to pay for the long spread, i.e., which makes up a butterfly, is only 10 points wide. That means that if the market truly tanks, this thing should be trading for $5 minus whatever debit you paid for it. And in our instance, we paid $2 for it. This is as of today. This is right now. So what can we do to the trade? If you look at it, I guess the least riskiest solution brings in the less amount of money, which makes sense. And I'll talk about that one first. So in this instance, market is 180 by 185. If we remove this leg and we remove this leg of the trade, you're selling the most expensive option contract and you're buying one of the short option contracts back, which you're actually going to be profitable on that trade, right? Because the market has gone up in that instance. And then this one, and by the way, these are puts. I should emphasize these are puts. And in this option contract, that's also lost money, but I can bring in a decent credit at this point in time. So the adjustment to the trade, and if you look at the bottom of the screen, is going to be, we're going to just take this out of the picture. The 605 is going to live. It's just noise right now in our trade. The short option contract is the 615. We're going to go down to one contract there, and then we're going to flip this around. We're going to be selling to close that option contract, and we would be buying to close, even though it says open, that option contract. So if we do this trade and we make it the least amount of risk on the trade, we're just going to roll into one short put spread. And that's all that we're going to have on. We're going to ride the bullish momentum. We have 1 day. Remember, tomorrow is the expiration. So you have a half a day today of trading, and then you have a full day tomorrow. If we do this trade, we can bring in a net credit of 70 cents to the account. And then what we'll have on is a 6015 by 6005. So 6015 by 6005, 10-point wide short put spread, which is bullish on the marketplace. Now, we could sell this entire thing, and we could salvage. It was trading for 33 cents, and we could salvage the 33 cents. We paid 202.10 for it, and we'll call it 30 cents. And then that means that we would have lost $1.80 on the trade. If we do this adjustment, we have the potential to bring in a little bit more of a credit. And like I said, I wouldn't mind doing it a little bit earlier in the day. But we still have risk, and we have a lot more risk. We're going to add $1,000 worth of risk. So not sure if you are excited about the trade, because now you're in a short put spread that's 10 points wide. But this is an adjustment that I have done from time to time on butterflies. And it's not the perfect timing, but then again, I don't determine exactly when the show is going to be. But it is a viable adjustment, I would say, at this point in time. The market has ran against you. You're going to remove this 60-30 strike. Your focus is going to be on the 615. And when this is all said and done, here's what the trade will be. And I'll do it this way, and I'll show it also inside the what if calculator. And as always, if you have any questions, please do put them in the chat box. I don't know what platform that you're on, but this is an interactive show. Feel free to ask any questions along the way. So here's what the trade will end up. If we pull this off for a 70-cent net credit, make the math simple, we're going to reduce our debit paid for the trade by that 70 cents. And then we're going to have additional risk on the trade, but it will be from 615 down to 605, 6,005, 6,015. All right, so here it is. Let's remove this leg. That one goes away. This one then becomes a short trade. Right there. And this would be the long trade. And this would, oops, just one of them. And that would be our position. So then we'd have to manage that position until expiration tomorrow on the close. Now, if I put that trade on and I bring in that 70-cent net credit to the account, which is interesting enough that this spread is now trading for 25 cents. But if I do bring in that 70-cent net credit to the account and the market goes against me and it turns and it goes down and I see it trading for 140 or 150, I'm just going to get out of the trade. I don't want to mess with it too much. I don't believe that you should ever really make more than 1 or 2 adjustments. On a short-term trade, it's only 1. I mean, maybe if you got a 45-day trade or a 50-day trade, you could look at making a couple adjustments. But in this instance, we have 1 adjustment where we don't want the cheese anymore. We just want out of the trap. We're going to lower our risk a little bit by doing this, or lower our net debit, which is lowering. Well, it's not lowering the risk, but it's lowering the debit that we paid for it. That's the only way to really say that. But we still have risk on the table. We still got 10 points of risk. And we did that to try to bring in 70 cents. And it's that simple. If you think that's worth the risk, well, then go ahead and do the trade. Now, if we go back and we look at the what if calculator, I'll leave that there and we'll go to the what if calculator. So we've taken this trade and we've flipped it, right? So we got rid of this option contract. We got rid of one of those option contracts, and then this became a long option contract. So if I take this and I send this to the what if, hopefully it just pops in. Nice. When you're dealing with the SPX option, sometimes it can drag on the platform. Okay, so in here, so now this is where our trade is. So we went from here, from this trade to this trade. Quite simply, we were in this position, we did the roll, now we're in this position. So now we want the market to stay above 6,015, which the one thing that's really nice about this trade is that when you do this, right, you want the market to come down to 630. Well, once we roll and you got the momentum of the market going higher, we're actually adding 15 points to our buffer zone, as a good way to say it, to our buffer zone before we get to our short strike. So by doing this trade, that does help that out. Now, there's a different adjustment that you can make to the trade. And let's go back to the the butterfly here, the modified butterfly. And let's send this to the trade ticket. Not bad. Okay, send a ticket. And I'll show you one other alternative. But this one adds a little bit more risk. I would personally just do the first trade that we had on. But one other way that you can do it and bring in a few more pennies, if you will, is to sell the 630. So we got the 630 trade here. We're going to sell that one and close that out. And then we're going to ignore the 615 and we're going to buy the 605. So we're going to sell the most expensive one and buy the least expensive one. Now, if you do this, I don't think it's worth it, because if you look at it, you're bringing in 30 more cents. If it may have been worth it on the close on Friday or based off the premium where we were at, but you're bringing in 30 more cents, but you're doubling your risk, because now you would be short 2 10-point wide spreads. Because remember, you have the 60-15 in here, and you would be short 2 of those, and you would be spread off with 2 of the 6,005. So it is an alternative. The market had ran more against you. Maybe you do it and you bring in a little bit smaller credit, but then you have less risk because the market has gone up higher. But in this instance, I'd much rather roll to the other one, pull in a 70-cent credit, and let that ride for the day. You got the rest of the day and all day tomorrow before that expiration date comes in. If the market does come down and starts trading somewhere close to your strike or anywhere in this range, about a 1 standard deviation move down, actually, which is highlighted here, then you'll probably have to just close it out. And this is the way the trade works. We put it on. We're bearish. We wanted the market to go down. The market didn't go down. We make an adjustment. We say, we don't want the cheese anymore. Just let me out of the trap. You're trying to get out at break even. You put that trade on. If right now we weren't quite at break even, but we brought in a small credit. If the market continues to run, the options expire worthless, and we lose a little less than we would have if we didn't make the adjustment. And that's the goal of the trade. That simple, that straightforward. All right. We have a comment. Here we go. Okay, that's a great question, Mega. How do you decide when's the right time? I prefer to do it based off of the net credit. Now, I guess we mentioned this on Friday, but we have 1 day to adjust this trade. If we could have, like today, we'll do a long call spread and we'll ride the momentum on the upside. And I don't have any problems being bullish all the way going into the new year. The new year, we have the Fed meeting this week and they could surprise you. That's always a possibility. But with where the VIX is at, the VIX is definitely not expecting it. We still got the VIX. Well, it popped a little bit. We're trading at 14.25 right now. But there is a little bit of risk of something that could happen in the Fed meeting. But with that said, how do I decide to adjustment? My best thing to do is to look at the value of the spread. So I'll use this one because we have this adjustment on, Mega. It's trading here for $1. So I would look at this, and when the roll happens and it's trading close to $2, I would adjust it. That's simple. On a short-term trade like this, when I could get the spread done for fairly close to that price, then I would adjust it. So I'm basing it off of the net credit of the roll. Okay, so this is right now it's at $1 here. Normally the market would probably have to go up, probably when the market this morning was up about 15 points, and this is just going off of experience. This thing was probably trading for $1.75, right? So you put it on for 210 and you're able to roll into the short put spread, pull in $1.75, and now you got 35 cents at risk. That simple. And so what well, it's not really too late. The next question, go ahead and said it's too late to adjust. It's not too late. You're bringing in 75 cents. You just got to decide if the risk is worth the adjustment at this point in time. So let's go back. Let's get back to the original. Let's go to the what if calculator. And let's take this and clean up the ticket. I'm going to send that to the ticket again. Go back. We got it all set up. Here's the adjustment. We ignore the 605 because that's going to be in our account. We don't need to look at that. That's just noise right now. And we buy to open, sell to open. We get rid of one of these. This would be a buy to close, and this would be a sell to close. And you're bringing in 78 cents right now. So here's the question. When I say it's too late for the adjustment, it's too late for the adjustment to do a lot of help. Now it's just kind of helping. But if we did the adjustment when this spread was trading for 175 or maybe 180, well, then that's fine. You really cut down your risk a lot, but you cut down your debit a lot, but you still have risk. So the question here is, if we do the adjustment, you're going to be short a 10-point wide spread. You're going to bring in right now, we'll call it 75 cents. Okay. You're going to bring in 75 cents for the adjustment, but you're going to be short a put spread, and you could lose $1,000 if you do that. So if you started up with a one lot butterfly, you do the adjustment, you have a one lot short put spread, you bring in a 75-cent net credit, and you got to manage that risk. So it's up to you if you think that this is worth it. And I don't mean by too late. It's right on the cusp. 75 cents is better than nothing. If you just closed it out, if you just went in and sold it, you're only getting 33 cents on the trade, right? So this isn't a bad adjustment. It's just not ideal. I would have rather have done it on the open and had that adjustment and brought in a bigger credit at that time. But then the market would have been a little closer to where your 615 strike is at. And that would have been the adjustment. That simple. Okay. Let's stick in the SPX and let's look at a bullish trade. So I would adjust this and let's ride the momentum to the upside, and let's look at doing our normal trade in this instance, which would be market's at 675. And yeah, we'll clear that out. Any other questions? If you have any questions, Meg, if that wasn't clear, I'm happy to try to answer them. But now we're going to just sell the at the money option contract and buy the in the money option contract. And we're going to stay in this expiration. So we're going to buy the 60.65. And we're going to sell the 60.75. Oh, we don't want that. We're in the wrong expiration. And we're going to go out for the rest of the week. And there's two, so we're in the normal monthly expiration. So there's 2 December 28 expirations. So here's another learning opportunity. This is Friday. This is the European style SPX, and this is the American style SPX. I always wanted to trade the one with the W in it. Those are the more liquid option contracts that, well, I shouldn't say that. They're both really liquid. But this one will trade all day on Friday, and this one stops trading on Thursday. This is the original SPX contract, and these are what they added after the weeklies came. So I want to use this expiration, the one with the W. Market's at 60.75. I'm going to go 10 points wide on my trade here. We're going to buy this one, and we're going to sell that one. All right. So we're going 10 points wide. We're paying $6.15, 60.75. Okay, so we're selling right at the money. We're selling all this time premium. We're buying less extrinsic value or time value than we're selling. This means that if the market stays where it's at 60.75, this trade would be profitable by $3.85. The maximum this thing can trade for is $10. This would be $3.85. Now, we do got a Fed meeting this week, and you got to be okay with that risk that's going along with this trade. But I'm going to let this ride. Now, a couple of days go by, and we get another couple of half percentage point updates. We can just get out of the trade if we'd like. We could probably sell it for $8.50, $9 on that instance. On the downside, if the market goes down, we're going to make an adjustment. We're going to actually turn this into a butterfly by bringing in a net credit. So if the market goes this way and it goes south, we will adjust this trade. And once again, it won't be a perfect adjustment where I'm going to do an adjustment and remove all my risk and make the trade perfectly without putting up any cash. So in this instance, I would just go and adjust this trade overall. And thank you, Mega, for that. I'm glad to know that we worked through it. So the adjustment here is if the market goes down, I'm just going to sell another 60.75 and buy a 60.85, or maybe even the 60.80, depending on where we're at. And then that brings in a net credit to the account. It reduces this risk. And then if the market comes back, you got a butterfly on. And you can potentially just close the butterfly and get out of the trade once again for a minimal loss or maybe even a small gain. So that would be the adjustment on this trade. Hopefully we don't have to have that. Hopefully the upside momentum continues and we wake up tomorrow morning and the market is up another 25 points and we get to the Fed meeting and we're already out of the trade. That would be ideal. That would be the best scenario that we could do. But once again, these are learning experiences. You can apply these to different type of trades. It usually works better on bigger indexes. You need a higher valuation to do the trade. I like the SPX because it is cash settled. I'd rather trade the SPX than the SPY, which is the SPX is 10 times the value of the SPY, or the SPY is 1/10 of the value of the SPX, however you want to say it. And that's always how I like to trade this trade and do that adjustment. So this will be the official paper trade for the week. And we talked about that on Friday's show, that we're going to wait till Monday and then kind of decide to what trade we wanted to do. We were hoping we're going to get that downside momentum to continue over the weekend that we saw on Friday. But as a matter of fact, we actually rallied into the close on Friday, and then the market is up this morning. All right. So other trade that I need to look at is we got BLK. So we went out, and I've talked about BLK last week on Monday's show, but now it's time to adjust. So what has happened in BLK, I like this underlying stock and I wanted to get long the underlying stock. And I do have to admit that when I was doing this trade, I realized once you got deep in the money, there's not a ton of open interest, first of all, and the bid-ask spreads are just really wide. So I decided to actually do a spread and sell a nearer term option against it, which is okay with me. If we're talking about paper trades and you're filling at the midpoint of deep in the money option contracts, you do it all the time. You would always, if I could trade $1,000 stock, $1,060 is what the stock is. And instead of buying 100 shares, I could buy an 80 delta deep in the money call that goes out to March. Our expiration is 3/21/25. I would always do that, as opposed to putting up all that capital to buy a couple hundred shares or even just 100 shares on a very expensive stock. The biggest thing is you got to deal with bid-ask spreads. So you need to have really liquid option contracts. And in our instance, they just weren't that liquid. So here's expiration that we chose, and the trade has done well. There's nothing wrong with what has happened with the trade, but the bid-ask spread is huge now. So we're 134 by 127. It's just $7. It just makes it really tough. It almost makes it want to think about just getting out of the trade. But we sold the near-term option contract against it. Well, we're profitable. I mean, well, we're still doing okay on the trade. And we sold the 1,055 strike call. So we're 5 points in the money right now after this $2.86 move up on the day. So if we're going to continue this position, I would want to roll that option contract. If I'm short an option contract, especially in the book, we call this a fig leaf, which is a leveraged covered call. We always say that it's a fig leaf with the tagline that you're kind of covered, in that you have something that acts like the stock, a deep in the money option contract, but you don't own the stock. So if you get assigned, you got an issue. In that you got to give shares, and you don't have shares. You have the right to buy shares, and then you get yada, yada, yada. Okay. So that's why I gave it the name the fig leaf in the playbook. And now if we look at this, and we're at 1,055, and unfortunately, the expiration is this Friday. If it was last Friday, we wouldn't have an issue because we just went in the money on this. So the expiration is this Friday, 1,055. We're looking at the 20th expiration. And we just need to be able to buy this back and roll it out. And so we have the ask price at 13.20 right now. Gosh, with 4 days remaining, that's implied vol is only at 20%. Gosh, that's still a lot of premium. And that's because it's $1,000 stock. That's why the premium is so high. So we'll probably avoid this earnings, and we're going to go out to the January expiration. So let's clear this out. We're going to have to sell to close this option contract. Oh, we're shorted, so we got to buy to close. I'm sorry. There it is. 1,055, 1,055. That buy. And let's look at the January expiration. This is 1250. What could we sell? We could do the 780. We could do this one. I don't want to get into earnings. Yeah, we can go here. 1270 gives us 10 more points to run. We're really close on this one, but I want to do it for net credit. So let's hit this. Then we're going to go from 4 days out to 18 days. And we're going to buy, and this would be an open. Okay. So we're bringing in a decent net credit, $2.60. I'd really like to go to the 280 and maybe, or to the 1,080 and maybe get it done for even, but that's just not feasible. I don't think it's feasible. Let's see. The spreads are so wide. Let me see here. Let's close this. Let's try selling that one. Yeah, that's a debit. So it's right on the cusp, but I'm going to sell this one instead. All right, that'll give us some time. So let's recap this entire trade. We went in and did the March expiration, which right now it's the 21st. There's 95 days away. We went deep in the money and we bought the 950 strike call. The 950 strike call. Now, that delta is, well, if we go out further in time, it's going to be a lot different. Okay, but we bought the 950 strike call. We've made really good money on that call option. We just had a wide bid-ask spread, and so we decided that we were going to spread it when we put it on. Now, the option contract that we sold is in danger of being assigned. We have a deep in the money option contract with a lot of time premium. We do not want to exercise that option contract and deliver the stock. So we're going to try to avoid assignment. How are we going to do that? We're going to roll this position. And there is a section inside optionsplaybook.com called managing your covered call or rolling a covered call. And that talks about when you want to do it. You want to do it when the underlying stock is fairly close to the strike price. And that is what it's all about. If it gets too deep into money, if it can blows through your strike and continues on up, you won't be able to roll and get a decent credit. Now, we rolled this one. I'd like to be able to even go up 5 points more and bring in a little bit less credit, right? $2.30 is where it's at right now, and have a little bit more room for the underlying stock to run. But this is the only one that we could do and avoid this earnings here on the 10th. So this is where we're at, January 3rd. And we want to put this all together. It would make sense to me if BlackRock would come out and actually split their stock. Who knows? Around earnings, that's when they like to announce it. So I wouldn't mind being in a position if they announced it. I think the stock would run. It would tighten up the bid-ask spreads. It would do a lot. It would do a lot for this stock. If the powers that be are listening to Options Guy TV right now, I think this stock would run if we did a 10 for 1, just like Amazon, just like Apple, Google did. All the mega cap tech stocks did it. So why not jump in? And that's where we're at. But the stock has been strong. It's had a really, really strong move to the upside. And this would be the roll. We would roll that position. I'm going to take a screen grab of that too. And now we'd have the 170. We'd set our alert for 170. If the stock gets up to 170, we either close out the position or roll it again. Now let's look at that March 23rd or that March 21st option contract, and let's see where that 950 is at. Right, an 86 delta. Oh, gosh, that bid-ask spread is just ridiculous. 132.20 by 126.00. All right. I'm just going to make note of that. So I'll go back and look at my notes and see where the trade is at. Do we have any other questions? Oh, Andrew says, what are the advantages of short-dated butterflies over a wide iron condor, 45 days out? Totally different trade. A short-dated butterfly, the biggest thing about a butterfly, and this comes from Andrew, the biggest thing about a butterfly, Andrew, is that if I'm doing the short-dated butterfly, I'm targeting something. And if you're correct on your forecast on a butterfly, you need theta to be your friend. You've sold 2 at-the-money option contracts if you're correct on your forecast, and you need time decay to erode. So it's a totally different position. That short-dated butterfly that we did on Friday was just looking for a small pop to the downside today. Now we're making an adjustment. I don't want the cheese anymore. Just let me out of the trap. Now, if I'm doing an iron condor, high probability of success, a lot more overall risk, but a much higher probability of success. And I'm going to address that trade a lot differently. Now, the biggest thing about an iron condor is you're selling an out-of-the-money call spread and you're selling an out-of-the-money put spread. And I wouldn't even put them really in the same realm as far as trades are concerned. And if I'm doing an iron condor in the SPX, you'll hear a lot of people, experts that will say, I'll go out 45 days. Because in that instance, I can get some time decay. But if the market goes against me, that time premium can protect me. It can allow me to adjust my trade or literally just get out of the trade. And that time value of our long option contract, there's still something there. And that allows you to close it out at less of a loss if the market surprises you in the short term. So a lot of people will do them a little bit longer, 45 days out. And, Tom Sosnoff and those guys will talk about the time decay from 45 days down to 25 days. And I've looked at that a lot. I like, if I'm doing short spreads and I'm doing them routinely, and that's what an iron condor really is, I would rather go out longer in time, let that time premium be my friend if the market goes against me, but I still want to be in a decent rate of time decay. And normally if I'm going out 45 days, I'm going to be out 20 days later. That's simple. That's straightforward. So I wouldn't put them in the same realm. It's not even the same outlook, the same aspiration. If we're doing it, I'm doing a much more speculative trade here. Much more speculative trade. All right. Yeah, and Lex talks about them all the time. Lex is the one that really turned me on to the modified butterfly, where I'm adjusting the leg, and he's one of the minds behind the Tradier Pro software too, to go along with it. I used to do a lot more butterflies, and after talking with him and watching his show, I've adjusted it to modified butterflies. Honestly, it just makes a little bit more sense. You pay a little bit more, but then you get a little bit more of a break if the market goes against you. All right, that's it. That's it for this edition of Options Guide TV, and I'll be monitoring the BlackRock position, and I may just get out of the trade here. If we can get this option contract to move up a little bit more, get this delta closer to the 95 level, I want to kind of ride it through earnings, but I don't know. Bid-ask spread is really bothering me. That's just too wide to be trying to deal with this. And I don't want to be forced to get out of the trade. And that's the biggest thing, is I don't mind getting into these things because you can work them just like we did when we got into the trade, by buying an option contract and selling one, creating a spread, giving yourself a little bit better chance of getting closer to the midpoint fill. But if you are forced to get out of the trade, if the market turns against you and you got to deal with that bid-ask spread, then that's not fun. That's the downside. Is I don't mind working it to get in, but it's when you got to get out because the market went against you, it can really hurt you. All right, that's it. Thanks everyone for coming. Please share with everybody. We want to make this an open forum, question and answer session. So please let everyone know. Follow me on X. My handle is @BrianOverby. You can stream these live through x.com, through the Tradier X handle or mine. You can do it on the Tradier Google platform or YouTube platform. And then also, if you want the whole gamut, you can go to hub.tradier.com and sign up. It's a free sign in. All you got to do is give your email address, and you will have access to all the speakers inside the Tradier Hub. Thanks for stopping in, and we'll see you this Wednesday for the next edition of Options Guide TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.